Hello, everybody, and welcome to this evening's webinar. It is so awesome to have you here with us. Before we get started, I just want to do a quick technical check. Somewhere at the bottom of the screen here, you should see something that says like Q&A. I believe it says it right below here. Do me a favor, if you can hear me and you can see me, just type yes into the Q&A so that I know that everybody is on. Okay, yes, looks good, sounds good, awesome, perfect, great. All right, so it is so exciting to have everyone with us this evening. I've got a presentation for you. We're gonna jump into that in about 30 seconds. We've got a lot of people coming on, so I just wanna make sure we're giving everyone a chance to join us. Grab a pen and paper, sit back, relax. We're gonna cover lots of juicy content about solo 401k contributions. And in just a moment here, we'll get started. I'm gonna share my screen so that you can see the presentation that I've prepared for you, and we will dig right into contributions. So you should be able to see my screen now, and we'll go ahead and get started. So this evening we are going to be discussing contributions to the solo 401k plan. Of course, just a quick disclaimer, especially when we're talking about contributions, this is not tax or legal advice. So if you have questions about tax advice, calculating those contributions, doing your final numbers, you do want to make sure that you are covering those with your CPA. And give me just one moment here. Okay, I thought our screen was flickering for a moment back and forth to my camera, but I think it's probably okay now. So we'll go ahead and proceed. All right, I think we're all good. So we just needed to get warmed up. So yeah, welcome everybody. And you can use contributions to your solo 401k plan to save more money, reduce your taxes, and grow your retirement nest egg. Now, before we really dive into things, contributions come from net profit in your business. You have to have profit in your business to make contributions. So if your business is just getting up and running, or if you haven't made any profit just yet, then this is going to be a great opportunity for you to learn more about the solo 401k and how these contributions work. And also, just a reminder, use the tools. We have contribution calculators that are available for you so you can determine how much you can put in your solo 401k plan. Just a little tip, remember to view the report on the contribution calculator page to see how to determine which portion of the contribution calculations are coming from the employee and which are the employer. Always check with your CPA to make sure your contribution calculations are accurate. And you can find that contribution calculator tool at solo401k.com/calculator. Now let's dig in. So if your small business has net earnings and profit, you can contribute some of that money into the solo 401k. Contributions can be pre-tax, that is tax deductible, or Roth, which is after tax. The total contribution amount you can make to the solo 401k plan is $56,000 or $62,000 if you are age 50 or older. And amounts are slightly higher for 2020. So because most of us are still wrapping up our 2019 tax year, maybe we're still making contributions to the solo 401k for 2019, the examples and assumptions that we're going to deal with this evening are going to use 2019 numbers. But we will tell you about those slight cost of living, the IRS calls them, contribution increases for 2020. There are two types of contributions to the solo 401k plan: employee salary deferral contributions and employer profit sharing contributions. Technically, there are other subgroups of contributions, including voluntary after-tax contributions, which is a type of employee salary deferral contribution. Today's webinar is going to be an overview of how contributions work and how to make contributions to your solo 401k plan. We'll be getting further into more advanced strategies like in-plan Roth conversions and the mega backdoor Roth strategy in upcoming webinars. And just one moment, I am still seeing that glitch here on my computer screen. Give me just one moment. Let's go ahead and continue. So, all right. First, we'll talk about employee contributions. Employee contributions must come from your business earnings, and you can put in a maximum of $19,000 as the employee contribution. That's $19,500 for 2020. But again, for the point of this evening's webinar, we're really going to focus on those 2019 numbers, since most of us are probably still in our 2019 tax year as far as reporting is concerned. These employee contributions, if you are age 50 or older, you get to stash an extra $6,000 in there, so you can really put in $25,000 if you're age 50 or older, and $19,000 if you are under age 50 as the employee contribution. For 2020, you can put in $19,500 as the employee contribution, and then $26,000 if you are age 50 or older. For the solo 401k contributions on the employer profit sharing contribution side, it must come from your business earnings as well. And then 20 to 25% of the net profits is how you're going to calculate your employer profit sharing contributions. And that's going to depend on your business structure, if it's 20 to 25%, which we'll cover in a moment. And now I just want to do another quick tech check-in. Let me know just by saying yes in the Q&A, which is right below the screen. Can you hear me okay? And can you see me all right before we get too deep into the presentation? Just give me a yes in the contribution or in the Q&A box. Let me know. Hearing and seeing okay. Yes, yes. Okay, awesome. Great. We're good to go. Cool. All right, so let's soldier onward. As a recap, for employer profit sharing contributions, again, we had said it's either 20% or 25% based on the type of business that you have. So if your business structure is a sole proprietorship, if your business structure is a single member LLC, then your employer profit sharing contribution can be 20% of your net profits above and beyond your employee salary deferral contribution. If your business is a multi-member LLC, a partnership, an S Corp, or a C Corp, then you can contribute 25% of your net profits above and beyond your employee salary deferral contribution. And as far as total contribution numbers, so we have some comparisons. For 2019, you can make a total contribution of $56,000, $62,000 if you are age 50 or older. And for the 2020 tax year, it's $57,000 or $63,000 if you're age 50 or older. So what we're all here to figure out is, what can I contribute? And there are 4 steps to determining how much you can contribute. The first is to determine your net compensation, and we're going to circle back to that in a moment. The second is to determine your employee contribution amount. Then you determine your employer contribution amount, and of course, add those two together, the employee and the employer numbers, so you come up with your maximum contribution to your solo 401k plan. So how do you calculate your net compensation? Because that is what that contribution calculation is based on. You can calculate your net compensation by this simple calculation. It's your net profits minus half of your self-employment tax. So right now, the self-employment tax for 2019 is 15.3%. Let's imagine that your net profits are $100,000. 15.3% of that would be $15,300. So if you have net profits of $100,000, your self-employment tax would be $15,300. And remember, to calculate your net compensation, it's your net profits minus half of your self-employment tax. So if we've already determined from this example that your self-employment tax is $15,300, half of that is $7,650. So going back to our initial calculation, net profits minus half of self-employment tax equals net compensation. In this example, that would mean of your $100,000 in net profits, $7,650 is half of your self-employment tax, which means your net compensation is $92,350. So that $92,350 is what you would use to calculate your employee and your employer contributions. And just a note, on our Solo 401k contribution calculator at solo401k.com, we already do this calculation for you. So if you know that your net profits are $100,000, when you plug that into the calculator, and we'll do some more examples later, our calculator is already going to do this net profits minus half of self-employment tax. But just so you know what's going on behind the scenes. Now, let's go ahead and dig in on where you can find out what your net profits are based on the type of business that you have. If you are a sole proprietor, then you want to look at line 31 of your Form 1040 Schedule C for your net profit. You can see there's a picture right on the screen of what Schedule C looks like. That's your profit and loss from a business if you're a sole proprietor on your 1040. And line 31 says net profit. So that's where you would take that number from our previous example, that would be that 100,000, and subtract 50% of your self-employment tax. And remember, you must have net profit to be able to contribute to the Solo 401k. If your business is a single member LLC, you are something called a disregarded entity. You're going to be treated, for this example, the IRS looks at you just like a sole proprietor. So you're going to use Schedule C income to determine your net profits. So where to find your net profit if you're a single member LLC? Same thing. Look at line 31 of your Form 1040 Schedule C for your net profit and subtract 50% of your self-employment tax. And just like with the sole proprietorship, you must have net profit to be able to contribute to the Solo 401k. So if your business structure is a sole proprietorship or a single member LLC, your total contributions to the Solo 401k plan can be up to 100% of your net earnings for the first $19,000 or $25,000 if you're age 50 or older. That's your employee bucket. And then 20% of remaining net earnings on top of that for your employer profit sharing contributions. That gives you a total of $56,000 in Solo 401k contributions, or $62,000 if you're age 50 or older. And now let's look into multi-member LLCs and partnerships. So you're going to look at Form 1065, your Schedule K1, and line 14. You must have net self-employment earnings to be able to contribute to the Solo 401k. And you'll use that same calculation that sole proprietors and single member LLCs will do as well. So you'll look at line 14, take that net profit self-employment earnings, subtract out half of your self-employment tax, and that number you end up with, that's where you can calculate your contributions from. If your business is a multi-member LLC or a partnership, your entity is going to file a 1065 tax return, and you are issued a K1 as the owner and partner. And as we just covered, you'll use line 14's value on your K1 to determine your contribution amount. And just to go over the total contributions you can make to the Solo 401k if you're sponsoring business is a multi-member LLC or a partnership, you can have up to 100% of your net earnings for the first $19,000 as your employee salary deferral contribution, $25,000 if you're age 50 or older. And then on top of that, for your employer profit sharing contributions, you can contribute an additional 25%. And that brings you to a total of $56,000 in total contributions, or $62,000 if you are age 50 or older. All right, Moving right along to S Corps and C Corps. If you have a corporation and you're sponsoring business for the solo 401k as a corporation, then you're going to look at a W-2. That's the payroll that you're receiving from your business. And you're looking at line 1 specifically. That's the box for wages. You must have wages shown on your W-2 to be able to contribute. The employee contributions are going to be listed on your Form W-2 in box 12, and you're in box 13. You'll check that little box for retirement plan, use code D. This is where we strongly recommend that you work with your CPA or your payroll company to ensure that this is completed properly. And just as a general rule for all business structures, remember, you cannot contribute more than you're actually receiving. That's why we take the time to go over and see, where am I supposed to find this net profit amount? How do I know what I'm making? If you have a Schedule C and you're only showing $10,000 on that line 31, then that's going to be your net profit amount. You can't exceed what you're actually earning from your business in your contributions. Couple more notes here about these corporations. If your business is an S Corp or a C Corp, you must receive a W-2 in order to contribute. Just having owner distributions on an 1120 or an 1120S tax return is not enough for the IRS and the solo 401k contributions. You got to show that W-2 wages earnings. And for the total contributions that you can make for a corporation, just like the other structures, up to 100% of your net earnings for the first $19,000 can be made as an employee salary deferral contribution. That number bumps up to $25,000 if you're age 50 or older. 25% of the remaining net earnings on top of that can be your employer profit sharing contribution. And you have a total of $56,000 in contributions you can make to the solo 401k plan, or $62,000 if you are age 50 or older. And again, just a reminder, we have these great contribution calculators that are available to you 24/7, 365. You can plug in your net profits, either calculated or what you estimate them to be, so that you can determine what your contribution amounts will be. And remember, the whole name of the game with these solo 401k contributions is to be growing your retirement nest egg faster, helping you to put more money away for your financial future, and also reducing the taxes that you're paying now. So it's an incredibly powerful tool, and the solo 401k has the highest contribution limits of any retirement plan out there. So now let's go over some examples of putting this really in real terms of how you can contribute to the solo 401k. For the first example, let's imagine you are a sole proprietor and you grossed $135,000 in 1099 miscellaneous income. On your tax form 1040, Schedule C, line 31, you are showing $115,000 in net profits. So you had, about $20,000 in business expenses, and you're 47 years old. You do not contribute to any other retirement plan. So as you can see on my screen, I've got a screenshot here of the calculator. The business type would be unincorporated sole proprietorship. The net income, that's what we're showing on line 31, is $115,000, and your current age is 47 years old. You do not contribute to any other retirement plans. So of that $115,000 in net earnings, there is still self-employment tax to consider. As I mentioned, our calculator is going to do the heavy lifting. So if you look at the report that the contribution calculator is providing for you, it's already going to have your adjusted earned income after the self-employment tax is taken out. And what we can see from those numbers are, you are able to contribute $21,375 as an employer profit sharing contribution, and that full $19,000 as the employee salary deferral contribution. which means that you have a total tax-deductible contribution to the solo 401k plan of $40,375, which is quite significant. I'll give you a moment just to jot down those numbers, since I'm sure some of you are scribbling furiously. These might be your exact numbers. So we've got $115,000 in those net earnings after the self-employment tax. You have $21,375 in an employer profit sharing contribution, $19,000 in an employee salary deferral contribution, and a total contribution to the solo 401k of $40,375. Now let's take a look at another example of you and your spouse participating together in the solo 401k. Let's imagine you and your spouse have an S Corp, and you each receive W-2 wages from your S Corp of $75,000. You're 51 years old and your spouse is 49. You contribute to a workplace 401k, you max out your 401k at work, and your spouse does not contribute to any other retirement plan. Let's look at your numbers first. You've already maxed out your employee contribution at work, so you still have your employer profit sharing contribution remaining for your solo 401k. As we covered, the corporation, the S Corp that you have, allows you to contribute 25% of your W-2 wage earnings. So 25% of $75,000 gives you $18,750 in total contributions for your portion to the solo 401k. You already maxed out at work, so you got your employer profit sharing left over. 25% of the $75,000 you're earning in your W-2 from your S Corp gives you that $18,750. And now let's look at your spouse. Your spouse is also in the S Corp with you, a shareholder with you, also receives $75,000 in W-2 wages from the business, and your spouse isn't contributing to any other workplace retirement plan. So they can contribute the full employee and employer amount to the solo 401k. Your spouse is under age 50, so they can contribute $19,000 as the employee and $18,750 as an employer, just like you can. If we add those two up, the $18,750 as an employer, that's 25% of the $75,000, plus $19,000 as the employee contribution, means that your spouse can contribute a total of $37,750 to the solo 401k. So let's look at those combined numbers. You're able to contribute $18,750. Your spouse is able to contribute $37,750. That means you have a combined total contribution to the solo 401k of $56,500. And this also means that instead of a total taxable base of $150,000, which would be your $75,000, your spouse's $75,000, you've now reduced that taxable base by $56,500 because your solo 401k contributions are tax deductible. So just take a moment to let that sink in, how powerful that can be to not only grow your retirement nest egg that much faster, have all of the opportunity for that tax deferred growth. And, over this coming year, we're going to talk a lot about different ways that you can capitalize on that tax deferred growth, but also to be reducing your taxable basis, your taxable burden, your taxable liability right now in the here and now. It's really a powerful tool. And I would be remiss if I didn't talk about Roth contributions. I know so many of us love Roth. Your employee salary deferral contributions can be Roth or after-tax contributions. These contributions to the solo 401k are not tax deductible. Instead, they grow and are later able to be distributed tax-free. Your total Roth contributions can be $19,000 or $25,000 if you're age 50 or older. Employer profit sharing contributions cannot be Roth. Employer profit sharing contributions are pre-tax only. So Roth contributions are limited to the employee salary deferral bucket of what you can put into the solo 401k. And as I mentioned at the top of our meeting this evening, there are some other advanced strategies that you can use to get more money into the Roth portion. We're going to be coming back to that in the later webinar, so we would love to explore that strategy with you as well. Now, let's talk about reporting these contributions because you want to get that tax deduction. Self-employed qualified plan contributions are shown on your IRS Form 1040, Schedule 1, line 15. And I know it can be challenging to keep up with these tax forms. It seems like they're changing all the time. So this is what we have for this tax year. This Schedule 1, line 15, you can see right there it says self-employed, SEP, simple, and qualified plans. The solo 401k is a self-employed qualified plan. When you put the amount that you've contributed on line 15, then that's how the IRS knows that these contributions are tax deductible. And you don't need to do anything to report Roth contributions to the IRS. Just complete the contribution form that we provide for you. We'll come back to that in just a moment. There are some of us that work a regular job in addition to our own small business for the solo 401k. So let's talk for a moment about contributing to multiple plans. Yes, you can contribute to multiple 401k plans at the same time. Employee contributions are capped across all plans. If we look at an example, let's say you are contributing $10,000 to your workplace 401k. That means you would be able to contribute the remaining $9,000 to your solo 401k plan as an employee salary deferral. And that's because you want to get to that $19,000 cap of employee salary deferral contributions. Your employer contributions for the solo 401k are not limited or affected by your contributing to a workplace 401k plan. That cap across plans is only relevant to the employee salary deferral bucket. If you max out your employee salary deferral contributions at your day job, you absolutely still have your employer profit sharing contributions left in the solo 401k plan. And that means you can still contribute 20 to 25% to the solo 401k plan. And that is still a tax deductible contribution. One more little item to note here, the IRS has something called an overall 415 limit. This basically just tells us that we can't contribute more than $56,000 to the solo 401k, or $62,000 if you're age 50 or older. You can't put in more than that 56 grand to any one plan. So even if you made enough money that you could potentially go over that limit, the IRS is going to cap that total contribution at $56,000 or $62,000 if you're age 50 or older. And, you know, as I mentioned, the solo 401k is such a powerful retirement tool because it has the highest and most generous contribution limits of any retirement plan that's out there. As far as contribution deadlines, you need to formally elect your solo 401k contributions by December 31st. I know for some of our newbies that just joined us in December, this is something we went over with some of you. You can formally elect your contributions by just completing that contribution form that's found on your solo 401k dashboard. Once you complete the contribution form, just store it in a safe place. There's no need to send a copy to Neighbors Group. And let's talk contribution deadlines. So you need to deposit the contributions into your 401k trust bank or brokerage account by the time you file your tax return, including extensions. So that is March 15th if you have a multi-member LLC or partnership. If you file an extension for your multi-member LLC or partnership, you have until September 15th to deposit your contributions. For everybody else, if you have a sole proprietorship, a single member LLC, an S Corp or a C Corp, you have until April 15th to deposit your contributions, or October 15th if you have filed for an extension. So we are coming to the end of our presentation here. I know I have a couple of pre-submitted questions. If you have some questions that you'd like us to cover, I'll try to get to as many as possible. You can type in your question in the little Q&A box at the bottom of the screen. But before we jump into Q&A, I want to encourage you all to mark your calendars. Our next Neighbors Group live event is on March 27th and 28th. The registration links will be emailed in the next few days. That will be in beautiful Scottsdale, Arizona. And we would so love to have you join us and come hang out, meet each other, learn a lot, and get a lot of value on how to continue powerfully using your solo 401k. So mark your calendars, March 27th and 28th, and we will have registration links emailed to you in the next couple of days. So let's dive into some Q&A. I do have some pre-submitted questions here from a couple of our eager registrants, so we'll dive into those first. The first question is, can you make Roth contributions to the 401k and commingle the funds for a single investment, like real estate? Or must the funds remain in a separate bank account? This is kind of a two-part question, so I'm going to go ahead and answer in a couple of parts. And we'll see if you can now see my face. Hello. So let's go ahead and answer this question in a couple of parts. The first is, must the funds remain in a separate bank account? From a bookkeeping perspective, it's a really good idea to keep your pre-tax money in one bank account and your Roth money in another bank account. Or if you're using brokerage accounts, you have a pre-tax brokerage account, a Roth brokerage account. That's going to make your bookkeeping and your record keeping much simpler. The first part of the question, can you commingle those funds, pre-tax and Roth, in one investment? Technically, yes, you can. But remember, the bookkeeping might be a little more challenging or a little more complicated because you're going to need to keep track of who put in what. Did the pre-tax put in what percentage? The Roth put in what percentage? And carry those through the life of the investment. So if you're doing a rental property or something like that, not only should all the income be divided among those tax classifications, but also expenses, repairs, property management fees, property taxes. To keep things simple, if you have sufficient funds to just do one tax classified bucket of funds per investment, that certainly makes things a lot easier. And then for the record keeping side of things, definitely have a couple of brokerage or bank accounts, one for pre-tax funds, one for Roth funds, and ditto for your spouse. So if you and your spouse are utilizing, let's say, both pre-tax funds, then you might have one bank account for your funds and one bank account for your spouse. Okay, so I have another pre-submitted question here. If I'm not making enough money to max out on the 401k contributions, is there any difference between taking profit sharing or employee contribution? Very good question. Of course, I'm not giving you tax advice. I would strongly recommend that you talk to your CPA. There's going to be personal items in your situation that I'm not privy to, so I can give you some general best practices here, which is if you are not maxing out a workplace 401k plan, definitely max out the employee contribution of the 401k, of the solo 401k first. That can be a really big chunk of your income. So remember, the employee salary deferral can be up to 100% of the first $19,000 or $25,000 if you're age 50 or older. That's a giant chunk of your income that can then reduce your taxes. So if you're doing your contribution calculations through our calculator, checking with your CPA, and you have the opportunity to max out those employee contributions first, then I say definitely go for that. So I see we have a lot of questions. Okay, let me see if I can go through those here. Okay, one moment. I got to scroll to the bottom. One second here. Okay, will you be sharing the slide deck when you are done? Yeah, absolutely. We will have this recording available to you guys so that you will be able to review the replay at your leisure and go over it again, that is no problem. We will certainly share that with you. Okay. Dimitri says, isn't it 20% employer contribution for a sole proprietor? Yes, it is 20% for the sole proprietor. Okay, let's see here. We've got another one. I didn't know that I needed to elect my contribution by December 31st. Can I do it now? That's tough. I would say to talk to your CPA about that. The IRS is pretty clear that you need to formally elect your contributions by December 31st. That formal election is that simple contribution form, and you do have until tax day, including extensions, to deposit those contributions. So make sure that you are talking to your CPA about that. Okay, Jimmy says, if I contribute $6,000 to my traditional IRA, can I still contribute $19,000 to my solo 401k plan, or $13,000 only? This is a great question, Jimmy, and I'm so glad that you brought this up. So if you are contributing to your traditional IRA, and you want to contribute to your solo 401k, you can absolutely do that. You're able to contribute to both at the same time. And the amount that you contribute to your traditional IRA does not take away from what you can contribute to the solo 401k. As long as you made sufficient income to max out that $19,000 in your business, Jimmy, then yes, you can do the $19,000 employee contribution to the solo 401k and the traditional IRA contribution as well. Okay, let's see. Yes, we had that question via intercom as well, so that's great. Okay, next question we have from Anonymous. Does the deadline of March 15th for a contribution, is that limited to transferring funds to the 401k checking account, or do they need to be invested as well? Fabulous question. They do not need to be invested by that contribution deadline. They simply need to be in the plan. So as long as you have the 401k bank account and brokerage account established and you have a place to put those contribution funds, then you have until tax day to put them in there, and then you can invest them whenever you're ready, whenever you find a deal that you're ready to put the funds in. Steve says, regarding Roth contributions, could you please elaborate on Roth funding sources and amounts? Sure. So Steve, the Roth contributions per IRS rules are going to be an employee salary deferral contribution. So that means it's based on your net earnings, just like we discussed, and the type of business that you have will determine where you're seeing those net earnings listed. If you're a sole proprietorship or single member LLC, look on line 31 on your Schedule C. If you're a multi-member LLC, look on line 14. If you're a corporation, look on your W-2. So once you determine how much money you're making, then you are able to decide if you want those employee contributions, the salary deferral contributions, to be pre-tax or Roth, or both. But you can't go over that $19,000. So let's say that you have $19,000, you have made sufficient income in your business, and you want to make those contributions. You can decide if you'd like to have all $19,000 be pre-tax, all $19,000 be Roth. Maybe you do half pre-tax and half Roth. That's a real personal decision. And there's more to that strategy that we're going to dive into in future webinars, but that Roth funding source is still going to come from your business earnings. So even Roth solo 401k contributions need to come from your business earnings. Okay. Another question here. Are you saying, even if my daytime job employer matched $5,000, that doesn't reduce the 415 overall 415 limit of the 56,000? Yes. Okay, got it. So that overall 415 limit from the IRS says what's the total you can put in any particular 401k plan. So even if your employer is matching your 401k contributions at work, that does not change the $56,000 amount for your solo 401k. You might arrive at that $56,000 calculation differently, remember when we did our example, let me see if I can share the screen. I'll jump to it one moment. Give me a second here. This is the one. No, we'll go back one more. Okay, so remember when we did this example of you and your spouse both having an S Corp together and you're both receiving W-2 wages and you're contributing to a workplace 401k plan. When you max out your workplace 401k plan, you're an employee there. The common denominator is you're an employee at your day job and you're an employee in your own business. That's why that limit is capped across plans. So if you max out your employee salary deferral contribution at work, then what you have remaining in the solo 401k is your employer salary or your employer profit sharing contribution, excuse me. So even if your boss is or your employer is matching, that does not detract how much you can contribute to the solo 401k as long as you're making sufficient income to be able to arrive at that number. All right. Wilbur says, can net rental income be considered when it does not show on Schedule C? Such a good and important question, Wilbur. For a sole proprietorship or a single member LLC, the IRS is very clear that your net profits, let me see if I can jump back on the slide one moment. So good to have these visual aids to help us out. So where to find your net profit for single member LLC? The IRS is looking for a number on line 31 of the Schedule C. So if you only have net rental income, or if a part of your income is net rental income and it's not showing on Schedule C, then that is not going to be included in your contribution calculation. All right, so next we have a question from Lisa. She says, earlier in your presentation, what can I contribute? What was number 4? Number 1, determine compensation amount. Number 2, determine employee contribution amount. Number 3, determine the employer contribution amount. And number 4, I'll jump right to it for you, Lisa, is add employee and employer together to determine your total contribution amount. Okay, so we are almost to the end of our time here. I know we have some great questions. We're going to try to get to as many as we can. One moment. Let's see here. Okay, we've got a great question here from Leon. What about an LLC taxed as an S Corp? Is it 20% employer contribution, like with a sole proprietor LLC, or 25% for an S Corp? It's 25%, Leon, so you can definitely do the 25% there. Okay. I know that we had some other questions here about voluntary after-tax contributions. We're going to cover that in a future webinar, so make sure you join us for that. Will you discuss ways to invest with partners buying rentals? Excellent question. We'll discuss that on a future webinar as well. And we'll take one more question here from David. Can I make more than one contribution to my Roth Solo 401k as long as the total doesn't exceed the total I'm allowed to contribute? Good question. I think what you're asking here, David, is, are you able to make multiple contributions over the year? And the answer is yes. The Solo 401k by Neighbors group, we provide total flexibility in your plan documents. You can make a lump sum contribution, you can make a quarterly contribution, you can make a monthly contribution. Whatever is ultimately best for you, work with your CPA to determine that, or perhaps your payroll company. You do have that flexibility. So yes, you can make more than one contribution to the Roth Solo 401k as long as the total doesn't exceed the amount you are able to contribute. So, okay, all right, guys. I know that there was a couple questions that perhaps we didn't get a chance to get to today. Please feel free to submit those to us. We would love to join, have you join us on future webinars. We have a lot of great information we want to cover with you as the year proceeds. It's going to be a very exciting, rockin' 2020. Make sure you mark your calendars, March 27th and 28th. We would love to have you join us in Scottsdale, Arizona for our Neighbors Group event. And if you have any questions at all, let us know. That's what we're here for. We want to be here to support you in using your solo 401k powerfully. Thank you so much for joining us this evening, and have an awesome day. Talk to you guys soon.